We are just getting started. Here we go. 3, 2, 1. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg. This is my live stream every Monday through Thursday at 4:30 p.m. Today we start off on a more somber note, and I would just like to offer up peace, prayers, and strength to all of our American servicemen and women, colleagues, friends, allies in Afghanistan, and we all hope and pray that our Americans or fellow Americans return home immediately and safely. And we're all watching what's taking place. If you missed it, President Biden just spoke a couple of minutes ago, and his point was he stands by his decision to pull out. He acknowledges how the situation deteriorated much quicker than expected, how the Afghan government, the political government, actually left the country, and their military dropped their weapons and ran. And he said it was an unwinnable place to be. 20 years, 4 American presidents, and he said he promised it was time to leave and he would take us out. And he reiterated his stance that the United States has no business being in the middle of a civil war in between other parties. They need to address it themselves. And he said it's not in the United States' best interest to be there, and he didn't want to see another life sacrifice for an unwinnable war that is not in the best interest of the United States. We hope and we pray. That's heavy stuff. 20 years giving the Afghan army money, weapons, training, military support. And when it came to the big test, it was a colossal failure. Very depressing, which is really not nearly strong enough of a word. Heartbreaking gets you a little closer. Okay, so we've got an interesting show today. We're going to talk about a couple of things. The ARK fund, we haven't spoken about that for a while. That's the Cathie Wood fund. We're going to take a look at that. We're going to take a look at the stocks in it and why Michael Burry is shorting the ARK fund, and we'll talk about who he is and why that piqued my interest and probably could pique yours. And we're going to talk about dividends, and we're going to take a look at a dividend ETF, and we're going to do a quick market update as well. I don't know if you know this, but as of today, the S&P 500 has now officially doubled off its pandemic low on March 23rd, which, by the way, was when I said it's time to buy right here on this show. We're going to roll a quick intro, and then we're going to get into it. This is going to be a good show. It's going to be interesting. While you're watching, if you have any questions, please ask away in the comments. Words of wisdom, words of encouragement are always appreciated. And if you're watching in the replay, welcome to you as well. Hit me up with any questions you have, and I will definitely see those, okay? And I can't wait to answer them. Thank you. Here we go with the intro. Okay, thank you very much for sticking at a very interesting show, and we're going to talk about some important market matrix. I was channeling David Katz of Matrix Advisors because he made an interesting point, and I want to make sure I touch upon that too. So we're going to do a couple of things in the show. We're going to cover a couple of things. So this is your post-market report, your daily dose of personal finance and your daily dose of encouragement. I want to encourage you literally to be the boss of your money, not for your money to be the boss of you. You know, that's very easy to happen. It seems that as we get older, hopefully we make more money, but people don't save because we grow into our spending. And the more you make, the more you spend. And it's very easy to happen. So we want to break that. Okay. We want to keep everybody here. James is here. Thank you very much, by the way. Hi, Mitch. I haven't watched your live for a while. Well, I'm glad you're here. I hope you guys in Melbourne, Australia are doing okay and getting through yet another shutdown, pandemic-induced economic shutdown in Australia. We're having our own wave over here. I'm sure you've seen it on the news. We just got approval for a third shot, a booster shot for the vaccines from both Pfizer and Moderna. And, it's for people who need it first. But when the time comes, I will definitely get my booster shot. I've already been vaxxed. And Jerry, hey, man, good to see you. I haven't seen you here for a while, and I'm really happy to see you. I just want to ask you, in your avatar picture there, is that like a LinkedIn or a Facebook ad above your head, over Lori's head? Because it's like, man, you're really into social media if it is, but I don't think it is. But great to see you, Jerry. And Phil is here. Phil wishes us a happy anniversary. Yes, today is my wife and I, our 29th wedding anniversary. I can't believe it's 29 years. It's, if anyone who's married as long as we are, I'm going to say what you're about to expect me to say. Holy cow, it's gone by fast. We are celebrating tomorrow, so I will not be here for the live stream. We'll be out east in the Hamptons tomorrow. So, it was just better for us to celebrate tomorrow than today. So that's why I'm doing the show today. But we will definitely order in some good dinner tonight, and looking forward to that. So tomorrow is a vacation day for me, and looking forward to that. Thank you very much, Phil. Let's just take a quick look at how things did today in the market. I'll pop myself up in the screen. So I think the big surprise to a lot of people is how well the market did today. Market, the Dow was down about 270, 280 points at its lowest point of the day. And it looked like, wow, this is it. We're finally going to see a down day, a down market. And of course, allergies are killing me. I think it's the blame for the allergies is the fires in California. The smoke and the soot in the air has finally made its way across the country. And I have noticed my allergies have been horrendous the last 2 weeks or so. But we've got, anyway, you watching the news over the weekend with all of that stuff. And I see you out there, Jerry. I'll get you up there on the screen. But look, we've seen all the stuff going on in the news with Afghanistan and how awful it is, and the comparison to Saigon when the United States finally left the Vietnam War. And pretty awful, pretty devastating. And you think that's it. That's going to be a big hit for the market. And it turned out all of a sudden, as the morning wore off and we started to head into, late morning, all of a sudden the S&P started to go up. All right. So here's a look at today's trading at the S&P. We started over here, and by about a little afternoon, we started to trend higher, and the market just climbed the whole day higher. And same thing with the Dow. The Dow and the S&P hit new all-time records today. So the Dow started heading up. It's not the screen. Around a little afternoon, also 12:30ish. So we started to really get. Hold on. That's not what I want to show you yet. We started to really see an uptick very early afternoon. And it was just, markets moving up ever since then. Why? How could we get past this news, this devastating news in Afghanistan? Look, I don't want to get to the political thing here. Like, oh, well, are you glad they left? Are you that we're pulling out? Are you sad that we're pulling out? I mean, I don't want to see Americans lose their lives and a lost cause, because it's just not fair. I mean, I don't have a child in the service, But I know myself, and if I had a child in the service, I would want him or her home in a peacetime effort, not a wartime effort. I think we can all relate to that, right? Anyway, so let me just go on, okay? So I think the big surprise of the day is how things went up. The Afghanistan situation was not an economic event. Afghanistan does not really have anything of value. It's not an oil producing. I'm not saying the people aren't. I'm saying from a commodities point of view, it doesn't make a difference in the global economy. I don't think there's even I don't think even using an electron microscope you would be able to see the impact that the Afghan economy has on the global economy. As far as a political event in the United States, typically political events like this don't have a major impact on presidents, nor do they have a major impact on the economy unless there was substantial loss of life in the decision. So, you know, that's why the market was able to rebound so quickly. Now we have to go into a few other things. So let's just take a quick look. So the Nasdaq was off, and I did see a number of tech stocks like DoorDash, Zoom, DocuSign, and others just get absolutely pounded today. Gold up a little bit. I don't know what the heck gold is trying to tell us. I mean, if I have to take a message from gold, I'm going to say inflation is not a worry, because gold is not trading up, it's trading down. It's not indicating any worry about any inflation at all. And it's had plenty of time to indicate that. Energy continues to go down. It was 75 not so long ago per barrel, 67. And the 10-year yield was starting to rise last week, about 1.35, 1.36 yield. Now it's back down to 1.26 yield. So the 10-year treasury is also telling you not to worry too much about inflation, but maybe the 10-year treasury is also telling you that the Fed wants to start tapering its bond buying program. But then, and inflation is the reason why. So at least as long as the Fed is addressing inflation, that's what counts. It's not if we have inflation or not. It's that if the Fed pulls its head out of its, to see the inflation light, and they do something about it, that I think is the bigger concern. The VIX was barely up, still around 16. It was 15, 16, 17. So it's right in that range. Russell 2000 small cap off 0.89%. That's the biggest loser of the day. That's a little bit of a worry because, small caps measure the domestic economy. All right. So these are some of the things that I want to put out there. LOL from Jerry. No, a background on the wall at Prime. Happy anniversary. Thank you very much. Oh, I see. Yes, I could kind of picture that now at Prime. Prime is a great restaurant on the North Shore of Long Island. So if any of you happen to visit Long Island, I'd love to take you to Prime. We'd have a great time. It's a great view of Long Island and the Long Island Sound, and you can see Connecticut out in the way. It's just, you see the boats go by. It's a beautiful place for a drink. Okay, and dinner. So let's take a look at a couple of things. So let's talk about the taper. The taper was expected to start next year, 2022. And then it's being talked about maybe it'll start November or December. That was last week. This week, talk of the taper is it could start happening by September, October. So we expect the Fed to talk about the taper in August at the Jackson Hole Symposium put on by the Federal Reserve. And sometime in September or October, the taper is supposed to begin, probably October. We were thinking it could take 10, 12 months to taper. And now it's maybe, 8 to 10 months. So what am I talking about when I talk about taper? The Federal Reserve buys $120 billion of bonds every month. It's been going on since the beginning of this year. So $80 billion of treasuries, $40 billion of mortgage bonds. And that pumps a lot of money, a lot of liquidity into the US economy. And now with inflation perking up, and now basically the Fed acknowledging that, yeah, the inflation is transitory, but some of it won't be transitory. Like maybe we're just on a higher uh, plateau of inflation. Still, nothing crazy, but we don't need, the economy doesn't need the help anymore. So maybe they'll go from $120 billion to $110 billion to $100 billion. And however long it takes, 8 to 10 months is no big deal. And then after that, the Fed is expected to begin raising its benchmark rates that it controls, particularly the federal funds rate and the discount rate. And these rates pretty much more or less start short term. They are very ultra short term rates, but they have an impact on longer dated yields for things like credit cards, mortgages, auto loans, things like that. So when credit is cheap, the economy can grow faster. When credit becomes more expensive, meaning interest rates are higher, it could slow down the economy and the economy could grow a little slower. We'll see. The last time the Fed tried to get out of this box of stimulus, twice it looked like they were going to spark another recession. The market tanked and everybody was in panic, and the Fed went right back to some kind of stimulus plan to keep things going and to assuage investors and all economic participants. So we'll see, but I do think it's, personally, I've been saying it's time for the Fed to taper, time to get out of the way and see how well the economy could function on its own. That might not be the most bullish thing in the world, but I would rather the market take its hit and then steady itself and then let the economy work it on its own, and the stock market will follow and act accordingly. Not any other way around where the Fed just is endless stimulus, because we keep saying it can't go on forever, the stimulus that the Fed does. It can't. But it has gone on for a very long time. It could probably go on for a lot longer. But I don't want to really test out that boundary. I don't want to be the one who tests the boundary. I don't want to be in the market when that boundary is tested. So I want to see things calm down. And as an investor, I'm willing to put up with the volatility because, myself and my clients, we're ready for the volatility. We expect the volatility. I think that's it. I think the key to handling volatility as an investor is to always expect volatility. As long as you know that volatility, substantial ups and downs in the stock market that sometimes last for a long time, 2-3 years, even more, when you expect that to happen, it makes you a better investor. It gives you that stick-to-itiveness that you need to be a long-term investor, to wring out the potential returns that the stock market could offer you. That's the key to getting through volatility. All right, so let's talk about the ARK fund. And I've got so many screens open right now that it's making my head spin. So Michael Berry, I'm going to pop him up on the share screen. All right. Michael Burry. The name is Burry, not Berry. Okay. Michael Burry also featured in the movie The Big Short. He is well regarded for sounding the alarm on subprime mortgages during, right before the Great Recession, and made a tremendous amount of money from being early to the blow up and shorting the bond market, shorting everything, and he made billions. Now he is shorting Kathy Wood's ARK Innovation ETF. This is the famous ETF, ARKK, very well known, attracts a lot of attention. It attracts a lot of, criticism. I don't think people should criticize it. I think there's more to it than that. But let's take a look. The key with ARK Innovation Fund is if you want a fund to invest in all these gee whiz technologies that companies are coming out with, and you don't want to invest in individual stocks, ARK ETF, ARK Innovation ETF is one way to go. All right. So let's take a look at what's in it. We haven't looked at this for a while. The expense ratio is 0.75%. It's got about 22 billion under management. Okay, about 48 holdings. I'm going to see if I can make this a little bigger for you. All right. Let me make that. Okay, so it's 0.75 expense ratio. Year to date, it's down about 1%. All right. And the stocks in the fund, I think, are worth noting. Tesla, Teladoc, Roku, Coinbase, Zoom, Square, Unity, Shopify, Twilio, and Spotify. Now, I don't know when the last time this has opened up, but I do know that Kathy Woods, let me show you a different screen here, okay? Palantir. That's not it. Let me just go to ARK. I'm showing you some guy, Mike Novogratz, talking about crypto, which is a whole other subject that we could get into. Okay, Palantir, P-A-L-A. I got that right. So Kathy Woods bulks up with $140 million of Palantir. Okay, and I don't know why it's not coming up, but it'll be right over here. PLTR. Okay, so that was down 40 cents today, down a little bit after hours trading. And then you take a look at the biggest position in Kathy Wood's fund, by far the biggest position is Tesla. And Tesla was down over $30 during the regular session, down over $2 and aftermarket trading. And that is from a high of 900. And then you take a look at the ARK fund. Let's pull up a quote on ARK. Down $3. No wonder it's down $3, because when your big positions are getting clobbered, your fund is going to get hit also. Now, the NASDAQ did not go down 2.6% today. Okay, this is just the ARK fund, because it's focusing on a much smaller group of stocks. So it's a more concentrated fund. As a result, it's subject more to the ups and downs of a smaller amount of positions. So we take a look at the ARK fund. Again, we remind ourselves what's in it. If you want innovation, it has Coinbase in it. It has Tesla. Now it's got Palantir. If you're looking for a fund that is truly all about innovation, then that's what this is for. This is not about saying, well, the NASDAQ is up 15% year to date, for example, and this fund is down year to date. Get rid of it. It's not a good fund. That is not what this fund is for. And if you're buying it for that, I think you're making a mistake, and you're probably not getting into it for the right reasons. Okay. So I want to show you a chart on this. Okay, and give you a couple of comparisons. But the thing to compare ARK ETF, all right, put myself up here, it's down from $159 a share. So let's say 160 to 117. That's a pretty big drop, especially in a market that appears to still be hitting highs almost every single day. But the fund is down 6% year to date, but up 38% in the last year. So down 6, up 38. And I think the right one to compare it to is the XLK, and that's the big ETF that tracks the tech sector. Okay. And that one is, instead of being down year to date, it's up almost 20% year to date. And instead of being up 38% in the last year, it's up 36.7%. So, and its expense ratio is a good deal lower. So I will pull up its expense ratio. That is not what I was looking for. All right, let's see. Let's get to I have so many screens open. Sorry about this, guys. I just want to make sure I get to everything as efficiently as possible. Okay. Let's take a look at XLK. This is the big tech stock ETF from State Street. It's one of the Spiders ETFs. All right. It's worth noting this is one of the ways I compare apples to apples and make sure that I'm getting into the right investments. Okay. The expense ratio in this one is only 0.12%. And I bet you it's got a heck of a lot more holdings. Okay. It's got a distribution yield of 0.7. It's got 74 holdings. And the biggest companies in this one are Apple, Microsoft, NVIDIA, Visa, MasterCard, PayPal, Adobe, Salesforce, Cisco, and Intel, as opposed to the other one, the ARK fund, which is Tesla, Zoom, and other companies you may or may not have heard of. Which one is better for you? Now, this is pretty concentrated too, because 22% of it is in Apple, 20% is in Microsoft. So not exactly a hugely diversified portfolio either, but do you prefer to bet on a fund with your biggest position as Tesla or your biggest position as Apple? And that's what I mean. So if you look at a chart on ARK, let's take a look at the 1-year chart. At one point, it was all the way up to here. Okay, so it was up to 160. The thing is, would you have sold ARK fund if it was all the way up there? And the fact is, XLK in the last 5 years is up, let's say, 275%, and ARK is up over 400% in the last couple of years since its inception. So which one do you want to own? ARK ETF, and I really want to stress this because I don't want to come off like I'm criticizing or knocking her. ARK ETF is for those investors who want a position in the most bleeding edge technology innovations. That's why it's called ARK Innovation Fund, that they could get. And it's probably anyone who has it, it's a small part of their portfolio. Or see, most people who have it, it's a small part of their portfolio. And it's made for somebody who really wants to take high risk, high return kind of investment. That's who it's for. Just want to get you a quote on Coin while I have you. So Coinbase was down another $4 today. It got pounded last week. The high on Coinbase is 429. Now it's 256. And that's like the third or fourth biggest position in the ARK ETF. So these are the kinds of decisions that you have to make in terms of technology. I'm more comfortable with technology stocks with true staying power, even if I don't get them at the earliest stage of investment. But that's me. And you could be different, and you're maybe have a different way to go about it. I think there's room for both. Okay. By the way, when I look at all these, I compare them to benchmarks, to averages, to indexes, and you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And then I want to talk to you about another person. I don't know if I have this person up here or not. Okay, yeah, here it is. I'll just give you a picture of what this person looks like. Okay, the guy on the right is David Katz from Matrix Advisors, and he made a point today to say that 2.5% of the time, dividend stocks trade at a discount to the overall S&P 500 in terms of their PE. And he was making the point that for some reason, dividend stocks or slow, steady growers that are dividend stocks aren't really feeling the love right now because investors are putting so much money into high growth in stocks. So people are going after, the Facebooks of the world, as an example, because they just have such incredible earnings generation. But what he says is once in a while you get a discount in a specific sector. Now, I'm not going to get into the stocks that he talks about, but I do think it's very, very important to look at a dividend stock ETF. And the one I want to show you the symbol, and you could follow along or check it out on your own, okay, is VIG, VIG, and that's the Vanguard Dividend Appreciation Fund. And this is one that I've talked about previously on the show, okay? It pays a dividend yield. Okay, that's why it's a dividend appreciation fund. But more so than just going after stocks that pay fat dividends, it goes into stocks that continually grow their dividends. So that's why it's it tracks the dividend growers, dividend achievers index. Okay, its expense ratio is only 0.06%. So almost all of your money is going into an investment as opposed to just an expense ratio. But all these funds that we're looking at, these ETFs, are fairly low expense. The ARK is definitely high for an ETF of 0.75, but that's what you pay for active management. This is not an actively managed fund. This is the VIG that we're looking at right now. All right, distribution yield is only 1.49%. So you're not getting a great dividend yield on this by any stretch. I mean, there are ETFs that can pay you much higher dividend yields, but this is companies that grow their dividend yields, okay? And I'm going to just give you an example of the stocks in it and how well it's done. I mean, you could tell by the chart right here that, you know, this fund has done very, very well. But let's take a look, and it still has 20% tech, but let's take a look what's in it. Microsoft, JP Morgan, J&J, Walmart, United Health, Visa, Home Depot, Procter & Gamble, Comcast, and Coca-Cola. And if you take a look at these 10 stocks, you know, the biggest of which is only a little over 4% of the portfolio, I don't think you could knock any of these companies, and I don't think you would be embarrassed with any of these companies. So the difference between these companies, like a Johnson & Johnson or a Walmart or a Procter & Gamble, and you're talking with someone who happens to be an individual stock person as well as an ETF person, okay, as a financial advisor. What I say to my clients to help ascertain their risk of determining whether or not they are suitable for individual stocks or if they should just be only in exchange traded funds. I don't even get into mutual funds, just ETFs or individual stocks, is that you have to believe that the stock you have, if it goes down, it should come back up. I think most people are of the mindset that if a Procter & Gamble or a Verizon or a McDonald's goes down a lot, they'll probably recover given time. But I can't say that with necessarily a DoorDash or a Palantir. I mean, those are great companies, but when one goes down, what is your confidence level that the stock could recover? And by looking at stocks like these over here, the dividend achievers, more or less, you give these stocks time, they generally recover and continue to move higher. And that's another way to go. So if you believe, like David Katz believes, that dividend-paying stocks, for the most part, are getting short shrift from investors, and you are looking for a way to get into these dividend stocks, the dividend growers, because dividend growers are consistently, historically, show more capital appreciation than just stocks that already pay high dividend yields. This is one place to look, the VIG ETF. All right, so I think that's it for the show. I really appreciate it, and Eric is out there. You are hands down the best information provider. Thank you, sir. Thank you so much. Go follow Eric, because I think he's selling himself short, because I think he's the best out there. And he is on LinkedIn every day putting out incredible content, all educational. We're part of a group of financial advisors all over the country who are creating a ton of personal finance, investing, planning content. It's all educational, and you can learn a lot from us. So get into our group and just, hang out with us once in a while. We would all love to see you here. Thank you very much. And I will not be here tomorrow. I'll be back Wednesday. Thank you all for making my day special by joining me. Until Wednesday, stay well.